Hi, everybody. Whitney Emanuel here with Whitney Wealth Group. I hope and pray you're doing well this wonderful Wednesday. I know that we're live, so I don't know who's viewing and who's not. So if you could just type in the chat that you're here, that would be great. This was originally scheduled for a Zoom seminar, but we wanted to go live. And what we'll be doing today is we will be going over a retirement case study. So what that means is a client, like many that I work with, we're going to have a sample of them, not an actual client, not with actual numbers, but just to give you a preview of what a financial plan actually looks like and how a financial retirement plan looks like and how to navigate the financial planning process, which can be very overwhelming, especially when it comes to retirement. Retirement lasts 20 to 30 years. So 20 to 30 years of your life that you need to plan income for, healthcare, it can be a lot. So my job is to break it down, keep it simple, and then bring it back to your values. How does this support you and your family and your spouse if you're married? Hey, Sarah, welcome. So I'm just going to hop right in. I have an hour scheduled. I don't anticipate it taking that long unless I get lots of questions. But I'm happy just to, as I said, won't go through an actual client sample of what doing a retirement plan actually looks like. Okay. So real quick, I'm going to actually share this. I'm actually going to share it to a page. I'm going to share this and then I'll hop right in. Just bear with me a second. Okay, perfect. So I shared this to my other page just to make sure that we are making sure that everybody can see as I go along. So why don't we just hop in? We're going to talk about some clients. Like I said, they're not real life clients, but it's based off of client numbers and families that I work with. And we'll go from there, okay? So let me get to the home page of their plan, and then I'll go ahead and share it with you. Alrighty. So I'm going to share. Hi, everybody. I haven't shared it yet, but if you come on, I can't actually see you viewing, so please just type a comment so I know that you're here. And then if you have questions, please make sure to ask them as I'm presenting, or I'll get to them at the end, but I just want to make sure that I address any of your questions as we go through the sample retirement plan for clients. Okay, I'm going to make this a little bit bigger so that people can see, and we'll go from here. So I use a software called Money Guide Pro. The first part of the financial planning process is actually gathering client information. I named this client couple Justice and Hope because I am all about justice and hope. And their last name is Purpose because we do purpose-driven financial planning. I don't know, I'm not that good at this type of stuff, but I thought it was nice. Hi, Linda / mother. She's my assistant, and she's hopping on for today's live. So we're going over a retirement plan for these clients that I hypothetically would work with. So let's just talk about Justice and Hope, okay? So Justice is 42 years old. He's employed. He's an executive at Target. He makes $250,000. Other income would be like rental income, disability, pension income that maybe he tapped into early. He doesn't have any of that. We've got Hope. She is 43 years old, and she's also employed, and I have her as a school administrator. So she makes $150,000. So joint household income is $400,000 before taxes and deductions. So that's their gross income. You'll see up here return method. What this is later on we'll get into it, but what types of rates of return can we assume in a retirement plan? So anyway, initially when I work with clients, I find out, one, we do a core values exercise. Once we get the core values and then all of your financial data, we put it in here and we start from just your income, date of birth. So that's here. I have their kids named Grind and Grit because they're hardworking, and so we've got here one 12-year-old and one 7-year-old. This matters for college planning specifically, but I always like to include people's children in here for estate planning purposes. We won't cover it today, but it is something that we do discuss. Something that we like to discuss when a retirement focused plan is what are your expectations for retirement, and then what are your concerns. So Hope is in the school system and she loves teaching. So she wants to work part-time into retirement. They both want an active lifestyle. They both want time to travel. They both want to spend time with friends and family, and they both want to volunteer and help others. So that's something, that's what they want their retirement to look like. High level concerns, you know, they're about 20 years out from retirement, so they're not so much thinking about this. We focus more on the concerns as you get really close to retirement. But one of the things that I know a lot of people their age are concerned about is that their parents might need care, and that could go into their retirement. So I'll make sure to include that, because regardless of the age, that'll happen. It could happen at any time, whether or not you're retired. All right, so those are the baseline assumptions for the plan. Now let's look at when they want to retire. So this could seem really far away, but it's good to start planning now, because when we determine when you'll retire, we can start calculating your costs today and how much you actually need to save to get there and fund retirement. Justice and Hope both said age 60 that they'd like to retire. Age 59 and a half is when you can get to your retirement accounts like your IRAs and annuities without a penalty. So that's a good age. We could look at earlier or later on. We have life expectancies. These are automatically generated in the plan. So 32 years in retirement for Justice, and then 34 years for Hope. And we have, I mean, are you willing to retire later? This is a part of the discussion that we have later, where do you need to retire later to be on track? And that's something for us to consider, because Social Security doesn't kick in at the earliest age of 62. Now goals, this is where we get into the nitty gritty. I've already pre-filled a lot of this. So what we have here is their income need for retirement. So this includes hobbies, fixed expenses, this includes travel, it includes gifting. All of this is included in these numbers. Again, they're a little further out. When I am within 5 years of retirement, I usually will have people actually give me a budget, and then we'll go off of their current budget. People don't normally spend less in retirement, so I just can move their budget forward. Since this is so far out for them, at least over 15 years, we just do a default total living expenses, and what that means is basically 60% of your income, and that's what we'll want to plan for your expenses in retirement. So we've got here, this is the number that matters. Both retired, their total income need is $228,000 a year, almost $229,000. And that inflates. This is something really important to consider, inflation every year. It's at 2.25 right now, but we might be in for some hyperinflation, which matters to you when you're doing retirement planning, because these expenses of $228,966 is going to go up every year by a minimum of 2% in today's environment. Another thing we really have to consider are healthcare expenses, and we have that included in here. So one thing that you'll see here is that they have a pretty high cost before they get on Medicare. Their healthcare expenses are about $1,300 more than when they get on Medicare per year. And then when they're on Medicare, and this has all been just used from current numbers of what people spend out of pocket for medical expenses. And the reason we have this as a separate line item is because it's fairly complicated, as you can see. They're both in great health, so I did include that. That lowers the cost a little bit. But this inflates at a much higher cost than inflation, over double at 5.05%. So that's another reason that we have this as a separate line item expense in retirement. Next, we've got their wants. So they want to travel and have a hobbies budget. So a lot of times people come to me and they just spend indiscriminately without having a budget. So we like to have a reasonable budget of $15,000 a year for their travel and hobbies. They are renting right now, so we also want to include a new home in their goals, and $250,000 down payment. It may not end up being that much. It's just something that we're putting out there. They also want to pay for all of Grind and Grit's college, and we assume the higher cost of private school, which is almost $55,000 a year. Something about this that's important to note is that this actually inflates at an even higher rate than healthcare costs at 6%. This can really hurt someone's retirement plan, so it's really important to consider college spending as a part of your overall financial plan. Keep in mind, these are what they want. We'll see if they can actually achieve it all. Social Security benefits are also automatically calculated in the plan, but I do get Social Security estimates. For people, I see here, Full Stride Leadership, healthcare expenses can be a really big deal. They're so expensive, and they can actually train wreck someone's retirement. So that's something that's really important to consider. Okay, so we've got, and again, if you do hop in, when we're going through this, just feel free to ask questions as I'm going, and I'll make sure to get them either during the live or after. I can type in your answers. So here we got, like I said, Social Security. We'll talk about Social Security and health of Social Security later on, but we do have the projected benefits today. Other retirement income is we have Justice, who's an executive. He was an executive at another company before. He's estimated to get a pension income from that in retirement at $100,000 a year. Investment assets is, of course, the most important part to most people's plans, unless they've got a huge pension plan. We've got a 401k that Justice, I'm going to estimate a higher current value of it. So as you can see here, we've got here we can break down all of the investments within your 401k, so that we were projecting forward the performance of it and how it's allocated, how well diversified. We've got here the contributions that the client is making. I say that they're maxing it out. The current maximum for 401k and 403b is $19,500. They can afford that at their current income. There's also a 6% match that the employer makes. And we've also got, sometimes you'll see this with some corporations, there's an additional match. It's not even a match, it's just an additional contribution from the employer. It's 5%. So the employer contributes 11%. And we've got here total contributions, then both employer and employee are $47,000 a year. 403b for Hope, because she works in the public sector and education. So she contributes the maximum $19,500, and then there's also a match there. So the total contribution every year is $27,000. So total additions, this is both employer matches and contributions and their contributions towards retirement, are $74,000 a year. We've also got, they got a trading account that they have with stocks. We'll put that into the plan because it is a part of their retirement. It's not something that I manage, but they provide me the information, so they should show me their shares and everything that they own. Again, this is just a sample client. And then we've also got a previous 401k that Justice had at a former job. So we come up with solutions for that too. All right, then for anyone who's just hopping on, would love for you to say hi. I'm going through a sample retirement plan so you can stick around and see some of the work that I do with clients, and share this too with your network if they'd like to know more about retirement planning. So this is just an arbitrary number, but it says, hey, are you willing to save an additional 13% of your income towards retirement? We get in more of the nitty gritty later. We do also have their insurance plans in here. I'm not going to get into an insurance analysis today, but we do their life insurance and disability insurance analysis. We also put in stock options. So what did I say for this client? I believe he currently works for Medtronic and then used to work with Target. I can't remember how I had put it, but either way, he's got stock options with both of those plans. The nice thing about this is that we can do all different types of scenarios around stock options because that is certainly a part of client income and assets. You'll also find that then you tend to be, when you have stock options, overweight in that company. And so it's a good idea to diversify. And that's a strategy that I use with a lot of my clients. Then we've got restricted stocks with Medtronic. So I think I have it as just as he used to work for Target, now he works for Medtronic. Restricted stocks are another type of stock benefit through an employer. They work differently. How restricted stocks work is that there's usually a stricter vesting period and you have to stay with the employer in order to benefit from them. Whereas with stock options that I had mentioned before, those will usually be able to carry them with you if you are met the vesting period. Again, I'm not going to go into a ton of detail, but this is something that we will really do a lot of scenario building with our executive clients. No liabilities because they currently don't own a home, but that is a part of a goal that I had mentioned earlier that they would need a down payment. All right, so then total net worth is almost $2 million, which is great. Now here's something that's cool that we do is we project forward what their risk tolerance is for retirement, okay, or excuse me, for their investment portfolio. And so what we do is we say, okay, what's your risk tolerance? We go through a risk tolerance questionnaire. So this is for Justice. He's aggressive. 88 out of 100 is what he scored. And so what that means is aggressive growth. And we project then that he'll earn 7.33% per year. There are different portfolios that we can put in here, but aggressive growth is what we generally go with. And that's a portfolio that I can administer for clients. Then we've got Hope, who's a little bit less aggressive, not by much, but still less. So because she's less aggressive, we project that she'll earn 6.77%. Now, keep in mind, this isn't how they're currently allocated. This is their ideal allocations based on what they told me about their risk. And I like to do that down here because we see here their current allocation, they've got a lot of cash. And they've got a lot of cash in their trading account. So then that brings down their long-term rate of return lower than what their actual projected return is based on the risk tolerance. So this is an area of opportunity to invest more according to their goals so that they can actually hit their goals. So let's go. So here's my favorite place in the plan. It's called the What If worksheet. Hi, anybody who's hopping on. I don't know if you're on, so if you want to type in that you're in the comments. And also, if you have any questions as I'm going through this sample retirement plan, let me know and we'll make sure to answer your question either now or after the live stream. So let's look at this. So current scenario is today, if the client made no changes, then we've got the recommended scenario. This is the one that we'll play with. And then we've got a cut college cost. We can build out up to 5 different scenarios, but for today, we're just going to stick with 2. I don't change this first one because, again, this is me not making any changes. If you just did nothing and you changed nothing with the plan, this is what would happen. So what this actually means, I like to define terms here. What is this confidence zone? What is the percent? So probability of success, it's something called Monte Carlo. It's a statistical test that is run in the software that runs your retirement scenario and your financial situation 1,000 different times. And then what it says is that 63 or 66 respectively % of the time you will have money at the end of your life, meaning you won't run out of money 63% of the time. The green zone is the confidence zone. That's where you want to be. But these clients, before having met with me, are not in the confidence zone. So it's my job to close the gaps so that they can actually be confident with their retirement. Because it's so far out, it's really hard to project. But this really puts numbers, an actual outlook for your retirement. And it does it statistically, and I don't want to say scientifically, but it's like the science of financial planning, basically. So let's look here at what each of these mean. So I'm going to go with this one because this is the one that we'll be working with, the recommended scenario, and kind of playing with this. So AG and GR, what does that mean? Aggressive growth, right, is their risk tolerance, generally speaking. But then we've got growth. So what that means, aggressive growth is the most aggressive portfolio. We scale down in retirement, after retirement, because people don't take on the same risk once they retire. We also have inflation here built in. So let's say you're earning 7.33% on average per year. Obviously, that can change every year. That's why we run 1,000 different scenarios in the software. So then that means after your inflation, earning about 5.08% return year by year on average. Then we've got here their retirement ages that we said 60, 92 and 94 life expectancy, respectively. We've got here their retirement expense of 228. We've got their healthcare costs that we looked at before, travel and hobbies every year, new home down payment next year, potentially, college for each of the kids. We've also got all of the retirement assets and income here. One thing that I want to mention is that I always account for 50% Social Security unless someone's within 5 to 10 years of retirement, just because the health of Social Security is not very good. I don't know that they'll cut Social Security income for people, but I do anticipate that they'll make people wait to file until maybe their full retirement age rather than making it accessible at 62. So age 67 is what I have here, which is their full retirement age. And usually clients like that I'm conservative when I plan with this. And so what we do is we say, okay, we'll cut 50%, we'll cut your Social Security estimate in half is the idea. So let's see. Okay. Good thing is that really didn't affect too much because they have so many other assets and savings vehicles for retirement and that income, the $100,000 pension every year from Justice's previous employer. So it doesn't hurt too bad to have that 50% Social Security cut. So that's one thing that I do with most plans, like I said, unless you're just about to retire. So here's what we'll do to try and make this scenario work. One thing I'll say is, hey, are you okay with retiring just a couple of years later? What about age 62 for each of you? What does that do to the scenario? You'll be surprised at how just waiting a couple of years really shoots that success up a lot. So we were in the low 60s before changing this. So what happens if you just save a little bit, if you save a couple years? Wow, it brought you all the way up to 70% rate of success. That means that you are successful in your retirement plan and not running out of money 70% of the time. One other small change that they can make based on their income that I'm going to show you is they cannot contribute to Roth IRAs. They make too much money. But let's say that they wanted to save into a tax-deferred account, meaning an annuity is a good tax-deferred savings account. So let's say they just did something like that. 10,000 Remember how we had said 50,000 before? They were very willing. So let's say they do 25,000 a year, Justice does, into an annuity in his name. And then let's say they did a tax-free life insurance account that they could save into, each of them, 10,000 a year each. So this increases their retirement savings by 45,000. These are just, we haven't even said where it's going to go necessarily specifically, but we'll say they're going to save $45,000. 20,000 of that is going to tax-free savings vehicle. 25,000 is tax deferred. So we postpone retirement 2 years for each of them, and then we have them saving $45,000 extra per year. I'm very confident with 82. I've never seen anyone hit 100 because you cannot be successful 100% of the time with 1,000 different scenarios. So 82%, I am personally, as a financial planner, very comfortable with that number. If they made no changes, but they cut college costs in half, what they'd contribute to college, that puts them to 63%, but they don't actually have to do that if they're willing to save more and delay retirement by 2 years. I'd say that's pretty darn good. So let's go. There are a lot of other things that you can change in here. But those, I think, so here's one thing that I see with a lot of my clients is that they've got some stocks that they've bought on the side, especially with executive clients. Stocks on the side that they've bought, they already have a Fidelity account because that's usually where their stock options are. So you've got your stock options account, then you've got some other stocks that you've bought. Then you have your 401k plans, and then maybe you have some executive compensation plans, but you don't really save intentionally outside of your retirement plans that are provided to you through work. So what my job is to create another income and savings vehicle or vehicles for you so that you can diversify and then have extra income in retirement. So that's essentially what we did. I also provided guidance on postponing retirement just by 2 years for each of you. You don't necessarily have to do that. You could save more to get on track, but usually what people like to do is a combination approach. So that's the story with these guys. Another thing that is really pertinent to them in particular is that we looked and you saw that they have these stock options, but they've also got that stock account. And what we do is something that I spend a decent amount of time on with is this allocation comparison. Where are you currently invested? How should you transfer some of the money that you have into a more diversified portfolio that'll end up returning more? One thing that I would recommend for these clients is potentially investing some of this money into a portfolio. Now, keep in mind that if they're going to do that home purchase, that is accounted for. So they may just want to keep this in cash for the home purchase. But if they decided not to do that, they could invest it according to the model. Another thing that they have here too is they may have a little bit too much in bonds. So we have them doing less in bonds. We've got here, they've got a lot in large companies, and I see this a lot with my executive clients that have stock options. In addition, people like large cap stocks when they're doing any type of stock trading because of the most established companies, but you're missing out then on the small size and mid-sized companies, which actually return more over time. So that's another thing that I see regularly. They could also increase some of their international exposure. They have very little international exposure. So that's another thing that I would recommend. So again, as you saw in the previous slide, they were earning under 7% in the current portfolio, but with my recommendations, they could earn almost 1% more per year, which really adds up with that compounding interest. So that covers most of what we do. I know I sped through a lot of this, but this is a very typical client that I work with, an executive, married, maybe the other client's not in corporate America, but they do still have some decent earnings that they can really siphon out to some other savings vehicles. So another thing too that we'll do is we'll do some additional stress testing with retirement plans. But before I talk about that, does anybody have any questions about this retirement plan for either of the couple, you know, this couple. Maybe it's for your retirement plan specifically. Happy to answer any questions. This is interesting because, you know how we had the needs, which were your retirement, and then also healthcare expenses in retirement? Well, then we added the needs and wants, such as college and buying a home. So if, let's say, they didn't pay for any college for the kids, which they will because they're purpose-driven people who put their family first. But let's say they didn't, and let's say that they didn't buy a home and they just rented. Then that would push their rate of success up to 91%. But the thing is do they really need to do that? This is a stress test scenario. I'm comfortable with 82% as a professional. So I'm actually okay with them paying for those things. Just another thought. Okay, full stride leadership. As a self-employed person, what are some benefits for retirement that are available to you? That's a good question. So let's just change the scenario a little bit, and let's say that Hope, the spouse of the executive in this scenario, is self-employed. She has her own business. Instead of doing a 403B, she could do a SEP IRA. If she doesn't have any employees, that's usually good. She could do a solo 401k, meaning just one person 401k if she doesn't have any employees. If she has employees, then she would need to consider providing retirement accounts to them. And that would be a simple IRA, 401k could be the options there. And then if you've got a ton of extra income and self-employment income, and let's say she earns more than Justice, then we may want to consider some supplemental retirement plans. But you've got a few options, and that's based off of your net profit, your adjusted gross income as a company. So if you don't have any income, then you can't do any retirement plans through your business. But if you're showing profit, that's when you can start to add some accounts and some plans through your business. Good question. Again, these are some additional stress tests to the retirement plan, but let's say that there was like a huge loss in the market right before you retired. Then you'd go from, I'm going to focus on the right because that's what we were going with, 82 to 69%. So timing of the market makes a difference. They've got concentrated position, right? So they've got a huge amount in Medtronic stock because they've got stock options. So fortunately, that's nice to get those benefits. But let's say there was a correction in that stock. It's $1.5 million that they've got in Medtronic. It seems like they're pretty overweight. So that obviously drops their rate of success if there's a big correction. So that shows why it's important not to have too much money in just one stock. That's either investing on your own or as a stock option plan. So that's why I work with clients to diversify away from their stock options. Sarah asks, do you factor in possible inheritance into retirement planning? Yeah, I do. I wonder if there's anything else. I'll answer that. I'll go back and show how we will project that. But let's look here at, let's say Justice requires long-term care when he's 85, and let's say it lasts 4 years and it costs about $80,000 a year. You need to go into, let's be realistic. It costs about $100,000 a year. Let's say Hope doesn't need care, but Justice does. And it's $100,000 a year, and it starts at age 85. What does that look like for the plan? Needs and wants is what we're looking at. It brings it down, but not too terribly. One thing this will do, however, is that it'll eat into your assets that remain, and it'll hurt your inheritance that you would want to leave to your children. So that's a serious thing to consider if you want to leave an inheritance. It can eat into your overall legacy that you want to leave. Okay, back to Sarah's question about what about an inheritance? Let's look at that. in a little bit more detail and how we could illustrate that. So go back into the plan. We go to money, other assets, future assets, cash, and inheritance. Whose inheritance? Let's say Hope has an inheritance that she could expect from her parents. Obviously, we don't like to think about when our parents could die, but it'll happen at some point. We don't know what the inheritance will be, but let's just pretend that we know. Then let's say you expect to inherit $500,000, just throwing a number out there. We would actually look at that, and it's good because it actually prompts a conversation that you need to have with your parents, because you should make sure that they have an estate plan in place. Not everybody does. And this is something that I also work with my clients, is their estate plans. So let's say that you're expecting $500,000 in 2040. Let's see how that affects the plan. So now that you're receiving $500,000 inheritance in all of the scenarios, what does that mean? It brings you up to 85% rate of success, and you'll see that here, 500,000. Let's say you don't want to include that in the plan, so it went from 85%. %. So it helps a little bit. It's actually surprising how it doesn't help more. And the reason for that is because you're not getting compounding interest on that inheritance like you are with your own money. You know it's being invested every year and growing at, we had showed either 6 or 7% depending upon how you have it invested. Sarah says, thinking about what I want to leave my child is something I didn't think about. We could plan for that too. Yeah, and another thing too is that is one thing that we really work with a lot in our clients is making sure that you have your estate documents in place, will, power of attorney, healthcare directive, but also trust planning if you have minor children or if your estate is worth a significant amount of money. You want to make sure you have a trust in place. Also, if you live in California, a trust is almost always needed. So that's another thing that you'll consider. So that's all that I wanted to share, is just a preview of what the financial plan looks like for my clients. So this is something that we customize to clients when they work with us. Linda, my assistant, does a lot of the data input. You work with her on the front end to make sure everything gets put in accurately. Linda and I review it before I do our initial meeting with clients. And the fee is based on the complexity of your plan, but it's something that it's great to put a plan on paper. Otherwise, you are walking in the dark. You don't know. These clients think that they're good. They've got the stock options, they got 401k, but you notice that if they didn't do any supplemental savings, they actually weren't well on track for retirement, and they could have run out of money pretty easily in retirement, especially with a big stock market correction before retirement. So things to really seriously consider. I really hope this was helpful and beneficial. It's my pleasure just to be here and help you. Provide some additional things. We learned about inflation and the impact that has on retirement. We learned about having cash on the sidelines and how that can put you off track for retirement. So we learned about a lot of different things. We learned about inheritance for your children, long-term care costs, and inheritance and how much that could affect your plan. So one thing about an inheritance too is the timing of it. We don't know, so that's a guessing game. But once things happen, we adjust the plan, whatever that may be. Change of job, change of income, inheritance, death in the family, any type. Maybe you need to take off work time away so that you have to take time and it'll reduce your income to take care of your parents. So those are things to all consider. Please contact me if you have any specific questions. You can send me a message here on Facebook, YouTube, or whatever platform that we're connected on. You can also visit our website at whitneywealthgroup.com, and you can call us at 612-296-6939. But we hope to hear from you, and God bless all of you. Again, I hope that this was very helpful to you. Have a beautiful rest of your Wednesday, and please let me know if you'd like to have an initial conversation about your retirement planning. Thanks so much.